Let's be real for a second. You open YouTube, and some guy in a rented Lamborghini is screaming at you to buy real estate or trade crypto options. Meanwhile, you're sitting there looking at your bank account thinking, "Buddy, I have $0 and a student loan that feels like a pet rock I can't get rid of." I've been there. The advice, "just invest," is useless when you're starting from absolute scratch. So forget the Lambos. Today, I'm breaking down the exact, boring, unsexy, but actually effective roadmap to go from $0 or even negative net worth to your first $100,000. We're talking about crushing debt, building a shield against disaster, and the specific ETFs you need to be buying in 2026 to let compound interest do the heavy lifting. This is the anti-guru guide to getting rich slowly. Let's get to work. Welcome back to the channel. I'm Ryan. If you're new here, we talk about money without the fluff. Here is the reality. Building wealth isn't about hitting a home run on a penny stock. It's about order of operations. Most people stay broke because they try to do step 3 before they finished step 1. They start buying stocks while they have credit card debt charging them 25% interest. That is like trying to fill a bucket that has a giant hole in the bottom. Today we are walking through the 3 distinct phases of the financial roadmap. Phase 1. Stopping the bleeding. Phase 2. Building the shield. Phase 3. The wealth engine. And stick around for Phase 3 because I'm going to share the specific 3-fund portfolio that beats 90% of professional hedge fund managers, and exactly how I'm positioning it for 2026. Okay, Phase 1. If you have high-interest debt, you do not have an investment problem. You have an emergency. Mathematically, there is no investment in the world that guarantees you a 25% return. But paying off a credit card with a 25% APR is a guaranteed 25% return. It is the best investment you will ever make. So, how do we tackle this? You've got 2 main strategies, and I want you to pick the one that fits your brain, not just the math. Option A is the avalanche method. This is the mathematically correct way. You list your debts from highest interest rate to lowest. You attack the one with the highest rate first while paying minimums on the rest. This saves you the most money over time. If you are a spreadsheet nerd like me, do this. Option B is the snowball method. This is the psychological way. You list debts from smallest balance to largest. You ignore the interest rate. You attack the tiny $500 debt first. Why? Because when you kill that debt in 2 weeks, you get a dopamine hit. You feel like a winner. Then you roll that money into the next smallest debt. Here is the trap though. Do not wait to feel ready to start this. In 2026, the cost of living isn't getting any cheaper. The only way to win is to get aggressive. Sell stuff you don't need. Pick up a side hustle for 3 months. Live on rice and beans. Do whatever it takes to get to zero. Because you cannot build a skyscraper on a swamp. Congratulations, you are debt-free. Or maybe you just have low-interest debt like a mortgage. Now, before you buy a single stock, you need a shield. We call this the emergency fund. Because life has a funny way of punching you in the face exactly when you can't afford it. The car transmission blows up. The layoffs happen. The roof leaks. If you don't have cash set aside, you know what happens? You go right back into debt to fix it. And we are right back to Phase 1. The rule of thumb is 3 to 6 months of essential living expenses, not party expenses, essential. Rent, food, utilities, insurance. If you are single and have a stable job, 3 months is fine. If you have a family, a mortgage, or a variable income, aim for 6 months. Now, where do you put this money? Do not, I repeat, do not leave it in your regular checking account. You will spend it on pizza. And do not put it in a traditional savings account at a big bank that pays you 0.01% interest. That is an insult. You need a high-yield savings account, HYSA. In 2026, interest rates have stabilized, but you can still find accounts paying decent yields, likely around 3 to 4%. This money needs to be liquid, easy to get, but separate from your spending money. It's not an investment, it's insurance. It buys you sleep. And sleep is expensive. Okay, the debt is gone. The shield is up. Now we get rich. Welcome to Phase 3. This is where we start investing. And for 2026, we are keeping it incredibly simple. We are not picking stocks. We are not trying to guess if AI is going to crash or double. We are buying the haystack. We are using ETFs, exchange-traded funds. Think of an ETF like a basket. Instead of buying one egg, one company, you buy the whole basket. If one egg breaks, you still have 499 others. Here is the Ryan Starter Pack for 2026. This is often called the Boglehead approach. Core holding, the muscle. VOO or VTI. This should be about 70 to 80% of your portfolio. VOO tracks the S&P 500, the 500 largest companies in the US. Apple, Microsoft, Amazon. If the US economy grows, you grow. VTI is the total stock market. It includes the S&P 500 plus thousands of smaller companies. Historically, the S&P 500 has returned about 10% per year on average over long periods. In 2026, with tech continuing to dominate, having this core exposure is non-negotiable. Diversification, the safety valve. VXUS. This is about 10 to 20% of your portfolio. VXUS is the total international stock market. Why do you need this? Because sometimes the US market stays flat for a decade while international markets boom. This is your hedge. Optional, the cash flow. SCHD or BND. If you love seeing cash hit your account, SCHD is a dividend ETF filled with companies that pay consistent dividends. If you are risk-averse, add BND, total bond market, to lower volatility. But wait, where do you buy these? Do not just open a taxable brokerage account yet. Follow this order. Employer match. If your job offers a 401k match, take it. It's free money. Roth IRA. Open this next. You pay taxes now, but all that growth? It's tax-free forever. Brokerage. Once those are maxed, then you use a normal brokerage account. That's it. You don't need 50 different stocks. You buy VOO and VXUS, and you just keep buying. Every month, rain or shine. Here is the secret that nobody tells you. The math is easy. The psychology is hard. The hardest part of this roadmap is the boring middle. You pay off the debt, you set up the auto transfer to your ETF, and then nothing happens. For the first year, it feels like you're shoveling money into a black hole. In year 3, your portfolio might drop 20%. The news will say the world is ending. But then, around year 7 or 8, something magical happens. The compound interest curve starts to go vertical. Your investment returns start making more money than your monthly contributions. That is the point of no return. That is where wealth is built. But you only get there if you don't sell when the market gets scary. So, here is your homework. Check your net worth today. Face the numbers. Pick your debt strategy, avalanche or snowball. Open a high-yield savings account. Set up an auto transfer to a Roth IRA and buy VOO. It's not magic. It's just math and patience. If you found this roadmap helpful, do me a favor. Smash that like button so the YouTube algorithm knows we're building wealth out here. And subscribe if you want to see exactly how I'm managing my portfolio this year. I'm Ryan. Thanks for watching. Now go make some smart moves.